Okay, so before we start this live stream, I have to read a disclaimer now. So anything I say here on this live stream, whether it's answering listener questions or talking about current events or anything like that, is for information and educational purposes only. Does not constitute investment advice. I will give my opinion, but that is all. You should contact your financial advisor and do your own due diligence. And I posted, to add to that there, I mean, it's getting kind of ridiculous with having to put disclaimers on everything, because I posted on my Facebook status about what happened to me, the story I told you guys on the last live stream with the Virginia State Securities investigators. I put that on my Facebook status last night, and there was like hours and hours of discussions, lots of people posting. And I mentioned Alex Jones on there, that first they came for Alex Jones, then they came for me. But just because I mentioned Alex Jones, some people were really, really vile in the comment section. I mean, this is with Alex Jones stuff, whether you like him or hate him or not, still free speech. And some people were even saying in the comment section, there was a few, not everyone, but some people who I've even been friends with in the past. Obviously, they're not libertarians, and this was before I became a libertarian. I was friends with them, but they're saying that I deserve the stuff that happened to me. It's the world is just getting more and more ridiculous, especially here in the United States. But before I start talking about some of the market and investing related topics today, I just want to thank everyone who has increased or started donating on my Patreon account contributions now. So we're up over $200 a month, and now I can go buy myself a new desk chair because I have a really, really old one that's like falling apart and creaky. So I want to thank you guys for chipping in there. Hopefully we can get it up to close to $1,000 a month or more, so I can afford to upgrade my business and do things that I should have been doing, but for YouTube destroying my ability to earn an income through creating this content. The funny thing, guys, I don't remember if I said this on the last live stream or not, but the personal opinion of the Virginia State Securities investigators was that they said this is not their official work opinion. They said their unofficial personal opinions was that my content was really, really good and it was very entertaining, and that I should be earning a good income from this. So they're asking me questions like, why can't you make a good income from this? Your content's really good. Why can't you earn a living? And so I told them that YouTube basically has made things impossible to the point where they've been siphoning off all my Google AdWords revenues. And then because my channel's not growing at the level it used to, advertisers basically, if they're willing to try things out for a month or two or three at all, then they end up canceling. So it's funny because like their personal opinions were, yeah, your content's really good, but their work official government investigator opinion was that, oh, your content's bad and you're a rabble rouser and you're causing problems. So I'm going to have to, in a lot of things, now I'm going to have to pre-qualify my opinion, pre-qualify a lot of the things I say, forward-looking statements, and that this is opinion, and my opinion, not financial advice. This is the shitty world we live in now, unfortunately, where you have to put a disclaimer in everything, and then people still complain and threaten you. Unfortunately, the society we live in now, people just don't take personal responsibility for their actions for a lot of stuff anymore. Okay, well, let's dive into the topics right now. So today marks the longest bull market in stock market history. So we have the longest stock bull market in history now, guys. I did not bring any party favors. I was thinking about going out and getting one of those New Year's Eve whistleblowing, one of those New Year's Eve, the annoying sound maker things, and blowing it here for a couple times, but we're just not fancy. Should we be celebrating? The Dow's almost at 26,000 again. The Russell 2000, which is a small cap index, for those of you who are not familiar, is up 400%, give or take, since 2009. And it's a really interesting time, because if you look at Zero Hedge, you will see that all these negative stories, but the stock market just shrugs this off. Whether it's the plunge protection teams or not, or people are just looking at certain things or not, or it's all just all the professional money managers and trend traders are all short-term. They don't care about any of the long-term things that we discuss in this podcast, is open for debate. But it seems that, the market is just shrugging off a lot of this news. On Monday, China intervened one of their plunge protection teams to try and save their stock market. This is the new normal that we live in. The new normal that we live in now is where these governments and these central banks will change the rules. I've been saying this for a long time. I've probably been saying this longer than anyone else, because I've studied hundreds of different experts and looked at their track records, inflation and deflation, And, one thing I've come away with not only studying the analysis of different experts, but also looking back through financial history, is that governments love to change the rules, whether you're a central banker or a politician. This is just the new normal. Okay, so let me talk about the stock market a little bit more, since you guys actually want, some of the research I do, and I'll share it with you. Okay, so Jeremy Grantham, who's a really famous investor. I like to study the great investors because, I do have my own opinions on things, but I think it's important to study some of the great investors. Especially if you're a beginner and you don't know what you're doing, it's important to look at the people with the really good track records, and going back through like the Jeremy Granthams, the Mark Mobiuses. There's tons of good experts out there, and just trying to weigh them and see how they view things differently. And Grantham, either late 2017 or early 2018, he wrote a piece for GMO, and he was saying that basically, even though the stock market, I think, went insane up starting in around January, that he thought the stock market could go about 30% higher in like a melt up, blow off top phase. And then it would be in a bear market for a very long time. So maybe after a recent correction a little bit in stocks for the last couple months, the stock market started to rally. Maybe Jeremy Grantham's going to end up being proven correct here. Yeah, I don't think... Sorry, I'm reading the comments, guys. That's why I'm taking a little break here. If I take a little break, I'm either reading the comments that you guys are coming in with, or I'm taking a sip of water. Have you seen the latest video on Real Vision from Raoul Pal? Deflationary pressures, commodities could go lower. Well, the problem by 100-ounce silver, commodities in the short term could go lower. Just my opinion. They could go lower, but then you're going to have miners going bust. I talked about this on the last live stream, that I'm hearing that there's a lot of problems now for copper miners, that they normally hedge things out, and that their balance sheets are in big problems, so they're starting to panic. But gold and silver miners have been, the primary ones, have been in a bear market for 7 years now, and so they've cut the cost to the bone. This may actually be good long-term, though, if the mines shut down. It would be good for silver, especially, if there was a drastic reduction in either primary silver miners or the copper miners got in trouble and had to start shutting down copper mines, because that silver byproduct could be in jeopardy. Okay, so let me talk about some of the additional research. So if you haven't yet, go back and read, you can Google it, go back and read the Jeremy Grantham piece. I think it's under 10 pages, and it's not in very sophisticated financial speak. So he says, in his opinion, normally Jeremy Grantham is a great long-term investor, but like a lot of great long-term value investors, they tend to be a little off on their timing, a little early or a little too late on things, but normally they tend to get the big picture correctly. And he said he expects like a melt up, blow off top based on no fundamentals. Maybe it's extra flight capital coming in from Europe or China. There's already been, as I've documented, a lot of flight capital coming in over the years into the United States markets and the major asset classes, but maybe expects additional flight capital coming in from there, and that would be his additional 30% move higher in stocks. So comment if you think you agree with that or not. The other piece of research that really caught my eye in the last week, Dr. Chris Martenson did a really great interview with Lance Roberts. He's down in Texas. Those Texas guys are real straight shooters. Well, a lot of them are anyway. And he's a professional money manager. He has an investing radio show, a good podcast. I've interviewed Lance once. I think either I interviewed him last year or the beginning of this year. I can't really remember because I've done so many interviews. But I should have Lance back on soon. But I would encourage you guys to go and listen to the interview that Dr. Chris Martenson released last week with Lance Roberts. And as a professional money manager, he talks about, well, from a valuation perspective, he knows that the stock market is drastically overvalued. But because he's managing money, because he has to pay bills of his own, he has to run a business, he has to collect management fees, he cannot go to all cash. Even though if he was probably doing it with his own money, he would probably put more of his own money into cash, but the customer money that he is managing, this is his opinion, not financial advice again. The customer money that he is managing, he is still in the stock market. He knows it's nosebleed overvalued territory, and it probably in the short term may go higher just on momentum, not on fundamentals. And he also talks in the interview, and I thought this was a very interesting point. He mentioned that like the S&P 500, it was either the Dow or the S&P 500. I can't remember which one he cited. But he said basically since 2009 that all the large companies in that index, they've only grown revenues 30% and earnings have grown 300%. So that shows you that there's not the earnings, the top line, not the earnings growth to match, not the revenue growth to match the earnings growth. And that to me points to financial engineering, mostly. Artificially cheap debt with central banks manipulating interest rates allowed them to do share buybacks with artificially cheap debt and goose earnings higher. And, this is the rent-seeking, short-term myopic game. Unfortunately, there's a real problem in corporate America, especially with publicly traded companies, the larger ones, where there's not a good incentive for long-term value creation for shareholders. I would like this fixed, but I don't want big government, federal government implementing laws. I would rather see this done at the bottom-up level from corporate board of directors saying, you know what, maybe our pay packages are not incentivized correctly, and that has to be fixed. Whereas they're trying to meet earnings goals every quarter, things should be like, oh, we have to create new products and services in the long term. We have to figure out ways to grow, revenue targets for legitimate long-term growth. So the company, the balance sheet isn't ruined. Because this is what, look at General Electric. Look at General Electric now. General Electric didn't even pay taxes. They had so many lobbyists and, cronyism and stuff. And still General Electric has had real underlying problems operationally. Okay, let me look at some of the comments here. Bjork. Are you talking about the musician, Omar? I don't know what you're talking about. Oh, Kirsten. Oh, you're actually on the live stream. You just said you didn't make any of the live streams. Okay, well, you're on this one. Fed has one playbook. Well, it's not just the Fed. So the Fed technically has not done QE since, October 2014. So the Fed has not done QE in almost 4 years. So it's been the other central banks, the other large central banks, the People's Bank of China, the Bank of Japan, the Bank of England, the European central banks that have picked up the slack. And there was I hope I can interview Grant Williams about this, get him back on. He did, if you're a Real Vision TV subscriber, definitely, if you have like an extra $180, $200 a year, it's worth the money on Real Vision TV for the interviews, the long in-depth interviews. And Grant Williams released an interview with William White. I think he works at the Bank of Canada now, but he used to work at the Bank of England and the Bank of International Settlements. And there was some interesting comments in there in that long interview. It was over 90 minutes long from William White. And William White was claiming, and I totally disagree with him on this, that the central bankers don't coordinate with each other. We know there's a lot of anecdotal evidence. There's a lot of circumstantial evidence that the central banks do work with each other. Ben Bernanke was writing academic papers, I think right before he left academia to go work at the Federal Reserve, and he was talking about how, because Ben Bernanke, remember, studied the Great Depression 1929 and writing about deflation and how the U.S. economy, the federal government could get an economy out of, the evil deflation boogeyman faster. And what Ben Bernanke talked about was that if all the major economies either inflate, do QE simultaneously, or they coordinate and take turns, then it wouldn't create hyperinflation anywhere, and it would fool enough people to where consumer price levels wouldn't rise quickly. So most people wouldn't even notice. And the other thing is, and I was going to talk about this, we were supposed to record a Welcome to Dystopia episode this week with Phil, but he had to reschedule, looks like next week, that I want to give credit to my friend James for this. He sent me, I missed this, that in January of this year, there was a speech at, I think, a Bank of International Settlements conference. So central bankers and other, high-level bureaucrats were there. And there was a vice president there from the New York Federal Reserve. And there's it's on the Bank of International Settlements website. GATA covered this on had a link to this. And in this, okay, the stream is back. That was weird. It was temporarily offline. I'm not even sure what happened there. As you guys know, I'm a technology idiot. So I think the stream was temporarily offline and we were back online. I'm not really sure if the video's going to get spliced into pieces or what. So we were talking about the Bank of International Settlement speech, and maybe I'll put a link to this in the info section. I was actually going to talk about this in the Welcome to Dystopia episode, but there was a speech in there talking about how there's been coordinated central bank cooperation, and they're openly putting this on the Bank of International Settlements website, because I think that they think that most professional money managers don't know or care. And the Lance Roberts interview echoes this. So the Lance Roberts interview was very telling because he's a professional money manager. He makes a living off managing people's money. And basically there's a lot of professional money managers on Wall Street or working in the financial industry throughout the United States and probably Europe that realize that the stock market is grossly overvalued, but they can't sell all the stocks. They can't go to all cash because they're risking career risk then. Even though they probably should be selling some stocks as the stock market goes up and reducing their positions, they can't do that because then they're underperforming the index or they're underperforming money manager competitors, and then their competitors will use it against them. Video output low. I don't know here. The video output's bad, guys. Oh, God. I hate technology. Alex Grant, stop informing all will be fixed. Who will fix it, Alex? Who will fix it? Cadusa says the most money printing ever. Yay. Yes, it's on an order of magnitude. It's orders of magnitude larger than anything ever done before. And it's not just the Federal Reserve. There's a lot of people who hate the United States, hate the Federal Reserve. It's all of them now. They're all working together. Well, except for China. I view China as on the other side, but China's gotten greedy with their credit bubble. And there's all these China bulls and people that are pro-China saying they have internal debt. Well, their state-owned enterprises also have a lot of dollar-denominated debt. There's a lot of other problems in China. Kirsten says, stock charts are just looking too strong. Yes, in the short term, the momentum players will. There's been plunge protection team stuff, obviously, in the U.S., but China's even involved in this now. It came out on Monday that they were coordinating going into their stock market, too. They don't want a stock market crash. The incentives for a lot of these governments now is they really, if you go and look up the numbers, the capital gains taxes for stock trades for annual U.S. tax revenues has become a lot larger than it ever was in the past. So there's been reports for months now that the U.S. with the Trump administration is spinning this as the economy is doing so well that there's record tax revenues coming in, but a lot of those increases in tax revenues have been from capital gains taxes, from people booking winning stock trades, not necessarily from the real economy. People who have to keep stocks to just buy up companies like Sandstorm Gold or companies that are legit undervalued. Yes, I agree. There's commodities companies, resource companies that are benefiting from these low prices. Unfortunately, a lot of primary gold and silver miners buy 100-ounce silver, with your comment, are so mismanaged that I don't think they're going to be taking advantage of the low prices here. In terms of the actual management teams, this is not financial advice. This is just my opinion. The main three mining company CEOs or board of people who are chairman of the boards who are doing the smart thing long term and buying up assets on the cheap long term. You have Rob McEwen, you have Ross Beatty, and you have Keith Neumeyer. Those are the three either CEOs, and that's because they have their own money invested. So a lot of these CEOs don't have any of their own money invested in the companies they're running. But Rob McEwen, Ross Beatty, and Keith Neumeyer do. Ross Beatty has formed Equinox Gold. That looks like it has a lot of potential. They're restarting the Arizona mine in Brazil. We'll see if that has any production problems in the ramp up. We'll have to see about that, but it looks like it has a lot of potential to be a winner. McEwen Mining is a very solid company. They bought the Black Fox mine from Primero when Primero was very close to bankruptcy. They bought the assets for literally pennies on the dollar. McEwen Mining did. So if they drill off those properties up in Canada, the producing mine around there, and they find more gold, that's going to be a big, big win for them. So McEwen Mining is doing smart things long term. I haven't looked at the stock recently, but I see with the things that they're doing long term, they're being contrarian here, and they're doing smart things long term. The other one's Keith Neumeyer, because they bought the other mine from Primero, I think San Dimas mine, and they have the capital. Yes, they did dilute their stock, but they do have the capital to optimize that mine with exploration, and they removed the silver stream and put a gold stream instead, and that should improve their project economics. Not financial advice, just my opinion. I'm going to have, guys, unfortunately now, because of all the people complaining, I'm going to have to be pre-qualifying a lot of my responses. It sucks, but this is a new normal. Cadusa, valuations are high, so blow off top sounds right. It's just another bubble, more to follow. Yeah, so if the bubble does burst, I mean, a lot of people, the people in power, people like my mom and dad who have 401ks and IRAs and regular stock portfolios, I mean, I don't think they would complain if the people in power went in and did more stimulus after a 6 to 12 month stock market crash. So if there was another stock market crash, I think there's a lot of people, whether you're a money manager on Wall Street or you're a regular person with a 401k or IRA and a lot of your money's in the general stock market, you're not going to care that much that the powers, the economic and political elites in power are going to be drastically devaluing currency, creating new money and credit to move your asset prices higher. Okay, let me look at my notes here to see if I'm mentioning all the stuff I want to mention. Oh, I wanted to bring up the President Trump stuff. Get your guys' opinions on that. You know, this guy's the mainstream media with the two stuff yesterday with Michael Cohen and Paul Manafort. The mainstream media is going to be, they're like sharks with chum and blood in the water now. I mean, they're going to be talking about this, repeating it like pretty much 24/7, 365. They're going to hope that this is going to affect the midterms and that the Democrats will gain back enough seats in the House to maybe start the impeachment process. This is going to be the best case scenario probably out of all this is probably gridlock in Congress now. Probably gridlock. It could get a lot even crazier than that. JD, how is everything doom porn when I'm stating a lot of analysis? In fact, I'm saying that the stock market is going up in spite of fundamentals. And if you go back and look at my work for years, I actually haven't been predicting a stock market crash immediately. I'm not like Jim Willey, where I've been predicting everything collapses every month or two. Go back and look at my old videos and work. I've been saying, I covered the currency swap story. I broke that with central bank to central bank currency swaps. And I was reporting in 2014 that many trillions of dollars extra were being put into the system by central banks, and that money would not stay there on central bank balance sheets or on bank balance sheets. It was going to go into asset markets. So I was saying that the asset prices were going to rise for no fundamental reasons whatsoever. Clifford Watson, since you mentioned GE, what's your opinion on GE stock after making a comeback or going bust? Well, in this market, GE should not be at the valuation it is now. But I think like a lot of value investors came in early, so it had like maybe a dead cat bounce. I think operationally there's still a lot of problems at GE. GE clearly has assets, some good ones. The problem is there's also a lot of waste there, and there's been a ton of financial engineering. The GE Capital stuff, they've been trying to unwind that. I'm not sure if they got rid of all of it, but if there still is problems with GE Capital, that could be a major lag on the stock. I mean, ideally though, they need to focus on, I think, the old saying, if you read like old Peter Lynch investing books or you talk to some of the really old great investors, is diversification. And I think GE became a victim of that. So Jack Welch, when he took over GE, he claimed that he sold off all these old businesses and he was focusing on only a handful of businesses where they could be number one or number two in the world and have the highest margins. And I think GE has gotten away from that to a certain extent. I think they are a victim of diversification. So I think operationally GE has challenges. The stock had a rally earlier this year. I haven't paid that much attention to the stock recently, so I can't really comment that much more. I'd have to look at the stock more. I'd have to read the annual report and the quarterly report, look at the footnotes. With a company as complicated as GE, you have to look at the footnotes. So in addition to looking at the financial statements, you have to read the footnotes. But I think GE has major problems operationally, and you know, it's really only been a year or two. Immelt did a lot of damage. Immelt was a big crony. Made himself very, very rich. Big crony, though. And he left the company. He's like one of those rent-seeking, parasite, myopic CEOs that I've been talking about. He left the company a lot worse than he founded it. Although there's an argument that Jack Welch did start things in the wrong direction. But I think the theory that Jack Welch said that GE should sell off a lot of their businesses instead of being too diversified, they should just focus on a handful of businesses where they can be number one or number two in specific markets with the highest margins. in theory, that sounds like the best business model they should have, but in practice, I think GE did not do that for a long time. I think they operationally have not done what they said. Havoc short, September's coming, the markets are struggling, be very careful, it will turn very bad without warning like it always does. Well, the old Wall Street saying is sell in May and go away, come back after Labor Day. So a lot more human beings, the really rich Wall Street guys will be back from their European vacations and their long vacations in the Hamptons partying. So they will come back, and we'll have to see how they react. But if the Fed is truly serious about ramping up QT to the $50 billion in asset sales per month starting in October, that's going to start taking liquidity out. But we still have a decent amount of liquidity coming in from the Bank of Japan and the European Central Bank. Although they're claiming that they're going to do tapering, the Bank of Japan said they're going to do tapering sooner. The European Central Bank said they're going to do tapering in 2019. We'll have to see. We'll have to see if they do what they say they're going to do. That's the problem with me. That's the problem that I see in a lot of society now. Whether you're a politician, a central bank, a business owner, just a lot of, even, regular people on Main Street with dating or anything, just people in general, society in general, especially in the United States, people don't do what they say anymore. And it's really frustrating. Yeah, the average Cadusa 1DL37, the average person, if they have like their only assets, and I'm using assets in quote for your home price, because if you live in your home, it's not really an investment because you're not generating cash flow from it. There's a lot of property taxes and maintenance costs and things like that. If you live in your own home, it's not really an investment, although people call it that. If you have rental properties, that's an investment. But yeah, a lot of people, their only assets, investments they own are their retirement plan and their house. And like I just said, their house is not really an investment. So as long as housing prices don't fall too much, don't crash, and as long as the stock market doesn't stay down for too long, most people, regular people, won't wake up and won't complain too much. Ben Furthy. In theory, the bull market could run longer. The problems coming down the line for the U.S. are the budget deficits. The budget deficits are going to blow out. The Treasury, there was a lot of extra borrowing that the Obama administration delayed. So there was stuff that Obama intentionally, and his Treasury Secretary and his other bureaucrats that he appointed, intentionally delayed hundreds of billions of dollars more per year in spending. So those budget deficits are going to blow out. You have, in addition to those Trump tax cuts, which are supply side economics, which I'm not really a fan of. So that is one problem. The other problem is the strong dollar. So if the dollar, when I recorded the last live stream on Friday, it was having a little bit of a correction. I think it was still around 95-ish. If the dollar rally continues against emerging market currencies and also against the other G7 currencies in the dollar index, it's going to cause a lot of pain. The best analogy I used is the one that I had the title and the little thumbnail on in the last videos. The dollar is a wrecking ball. A strong dollar is a wrecking ball to the global economy, because there was a lot of irresponsible borrowing in dollar-denominated debt by large banks and foreign governments, by politicians in foreign governments and emerging markets. There was just... And hedge fund managers are calling this a dollar shortage, which I don't think is accurate. I would just call it irresponsible borrowing in dollars, betting that your own currency will strengthen against the dollar. And we know through financial history that over the last 30 or 40 years, every time the dollar has had a rip your face off rally against other currencies, especially emerging markets ones, it's caused big problems, to where the initial currency swap bailouts, guys, started with the Asian tiger crisis and the tequila crisis, and they're really, really small compared to where they are now. The credit Ponzi back then, the global credit Ponzi scheme, was nowhere near as large. Okay, I'm going to look at more of your questions, and I'm going to check my notes, and I'm also going to take a swig of water real quick. Yeah, so I'm trying to get Eric Cinnamond to come on a podcast. If you're not familiar with him, he was one of the top performing money managers for small cap value. He was number one at one point in the entire world. He was ranked. And what he does now, the level of research, he follows 300 companies that are publicly traded that are considered small caps, and he follows them extensively, listens to all the conference calls, the financials, etc. And so what he's been seeing since the first quarter of this year and in the second quarter with the conference calls recently is that there's a lot of extra inflation in the global supply chain through tariff increases, the trade wars that Trump has, and then also with higher basically I would call it stagflation, where because of all this extra money and credit and misallocations of capital, that all these companies are having higher input costs. But what he says is that a lot of these companies, they've eaten some of the cost for a while, but they do think, they mentioned this in their conference calls, that they're going to be able to pass on the cost, at least some of them, onto their customers, that their customers are going to be willing to pay higher prices. So that wouldn't totally destroy profit margins, at least for some of those businesses, because you'll hear some value investors like Vitaly Katsenelson. I interviewed Vitaly about 5 years ago. I think it was 2013-ish. I had him on once, but I do follow his work. And Vitaly's a really smart guy. He's not really a macro value guy. He's just bottom up value. And what he has been saying for years is that eventually the cycle will turn and that profit margins will revert. And, he has a lot of research and evidence backing this up from a lot of past stock market cycles where profit margins are cyclical. Profit margins are cyclical and mean reverting. But we have not had that since 2008 and 9. And I spoke to Eric Cinnamond about that in some emails. But he thinks it will eventually, that profit margins will mean revert, but they might not mean revert for a while. We'd have to have the asset prices we'd have to have a crash and it would have to stay there for a while from what it sounds like in his opinion. But I'll keep on trying to get him on a podcast and ask him questions like that. Cadusa, not financial. Yeah, I mean, it's gotten ridiculous, Cadusa. If I just type like a sentence or two about something that people are these are smart people that I'm friends with, but they just don't want to take any responsibility for any trades or investments that they make when they go bad. They want someone else to blame. It's really sad. So I'm going to have to put disclaimers on absolutely everything now. It's getting so ridiculous. And even still, people are probably still going to threaten me. It's gotten unbelievable. The world we live in is so litigious. It's just ridiculous. And no, like I told you guys, no lawyer, even a local lawyer, even wanted to take the case the case had it actually proceeded. So thank God it's over for now. Jonathan Whiting, peak silver soon. Well, I've discussed this at length. So it's these peak things, peak gold, peak silver, peak oil. It doesn't mean we're ever going to run out of supply. It's a function of price. So if we get to, I'll give, this is not financial advice. This is, just a case study. So if we get to $200 oil, there's plenty of other supply that can come online. The problem with $200 oil is that a lot of the marginal consumer, the discretionary income for consumers will evaporate. But at $200 oil, it basically makes economic sense to almost all deep water offshore wells that are on the ocean floor or below the ocean floor to start drilling those again. So that would be a lot more supply. It makes a lot of sense for all the oil sands. It makes even sense at $200 oil, guys, there's asphalt. So asphalt is a petroleum product. I think there may also be coal in there too, but it's mainly a petroleum product. But at a certain oil price, it becomes economic to start basically jackhammering the asphalt and remelting it and then separating it out, kind of like a tar sands operation, and separating it out into oil and petroleum products then. But so it's a function of price. If we're below $15 silver now when we're recording this, when we're doing this live stream here on Wednesday, August 22nd, and at silver below $15, it honestly doesn't make a lot of sense for the primary silver miners to be producing silver still. The problem, as I've explained ad nauseum now for a long time with my short videos and interviews and other stuff that I've commented on the silver market, is that the primary silver miners, a lot of them have bad debt and bad balance sheets. And so even if they're losing money on every ounce of silver they produce, or on a lot of the ounces they produce, their higher cost, they want to still run the mine. It's really sad. And you'd think that, in theory, in a free market, when you study economics and supply demand of a commodity, that you'd think if demand had dropped and price had fallen, you'd think that supply would fall too. But that's not what has happened yet. So despite the silver price at the levels we're at, silver supply has not fallen yet. So there's been a lack of investment long term for primary silver miners. They're not spending that much money in exploration. A lot of the new potential silver mines in the future are not anywhere near economic at current silver prices. A lot of them are only economic at $25 to $30 an ounce silver or higher, but they haven't shut off the mines yet. They've high graded them. They haven't. Some of the production has fallen a little bit at some of the primary silver mines, but it hasn't fallen, like 20% or 30% or anything. It's not at those levels. And in fact, in some of the countries where the silver price may be higher in a different currency, there's actually been increases in silver production. So Mexico, I believe there was an increase in silver production, and maybe even Peru, I think. The silver market's manipulated. You guys know this. A lot of you guys know this. I've been talking about this for a long time. Oh, another thing on research, if you guys are very sophisticated and you want to learn more about kind of why the European banks are in trouble now, and they're still in trouble from a long time ago, go to the Macro Voices website. Oh, this is not for beginners. This is very, very financially sophisticated people with a high financial IQ. Go to the Macro Voices website, and season 2 of Eurodollar University just launched there. And so hedge fund manager Jeffrey Snyder of Alhambra Capital Partners, he's talking about in season 2 what happened in 2007 and 8 and how the Eurodollar market broke and the commercial paper market broke and how the Fed wasn't able to fix it. And the banks, especially European banks, they wrote into contracts for a lot of mortgage-backed securities and other over-the-counter derivatives. They made themselves liable for many, many trillions of dollars in liabilities that they can't possibly pay back. And so it was as bad as AIG was, and AIG was really bad during 2008, the European banks put stuff in contracts because they thought they would never have to pay it off. They put many trillions of dollars in liabilities into contracts, and they're on the hook for those. So that's why, in my opinion, the Federal Reserve has been giving the European Central Bank currency swaps. That's why the European Central Bank has been doing QE for a long time, for the last couple years at least, and the balance sheet has exploded. And that's to delay collapse of European banks. So basically, from what they're not done with season 2 of the Eurodollar University, but from what it sounds like, the problems in the European banks that started in 2007 and 2008 with the commercial paper market breaking and the Eurodollar market breaking, which is over $14 trillion. The Eurodollar market future stuff, I think, is over $14 trillion, and there's investment bank to investment bank currency swaps there. And so that's not even counting like the off-balance sheet items and the over-the-counter derivatives items. So this could go on for a while with the European Central Bank doing these games. Well, like, they might claim that they ended QE in the near future, but basically it seems that the covert, the stealth QE with the currency swaps and the backdoor bailouts and all those games are going to have to continue because no problems were really fixed. Counter Crow, I would just say that peak metals is more a function of price. Peak metals is more a function of price. So at certain prices, we're at gold and silver prices where gold and silver prices for a lot of the higher cost miners are below the cost of production. You have a situation, so this cannot continue for a year, 2 years, where you have the paper metals price running below the cost of production of the miners. They're not going to be able to pay off their maintenance capex, which is maintenance capex to keep the mine running. It just does not make financial sense. So miners can do this for a week, a month, a couple months, maybe a couple quarters, but then it just does not make financial sense, especially if the miner has a bad balance sheet. Even if the miner has a decent balance sheet with not too much debt, if they're running their mines at, say, $1 or $2 an ounce loss, it's going to catch up to them because they're not going to be able to afford the maintenance capex on the mine. At some point, they're going to have to go sell shares to pay off the maintenance capex on the mine. They're going to have to take on debt, or they're going to have to sell the mine. So they need the cash flow. That's why they haven't shut down the mines right away. The Watchman 2011. Yes, I agree. High oil prices cannot be sustained. Yep. So I did a short video on this earlier this year, and I talked about the global economy needs a Goldilocks oil price. It can't be too high and it can't be too low. But the problem with oil is it's very volatile. So it does go temporarily to an extreme, and that causes major problems. But ideally, if the market wasn't the oil market's also manipulated. There's a lot of manipulation in there as well. But the oil market, for the global economy to function smoothly, the oil market would have to be in a Goldilocks trading range. But if it goes too high, the consumer can't afford it, and that'll cut off demand. And if it goes too low, then the suppliers go bankrupt. I mean, even at this oil price, Venezuela's in trouble. I don't think Venezuela would be in anywhere near the trouble. The collapse wouldn't have accelerated if oil prices were at $100 or more. But this lower oil price and the oil price staying low for a couple years ago, it stayed low for a while. That really hurt Venezuela more than other countries, because Venezuela is such a mess, and so much of their annual revenues are based on oil. And Venezuela, their government is so mismanaged, they didn't keep any cash on hand. Like the Saudis have a enormous foreign exchange reserve and sovereign wealth fund and stuff, and that can get them through tough times, at least in the short term, for a while. But Venezuela doesn't have that luxury. Alex Grant, the economy can't afford high oil. We already have seen northern states. It sucks. And the economy can afford a high oil price for a while, Alex, but you start to see people carpool. You start to see them cut. What would get hurt the most, in my opinion, on a higher oil price would be restaurants and retail. Those working class or middle class consumers, they would probably not buy as many SUVs. And they would probably also, the restaurants and retail, we're already seeing problems in restaurants and retail. They've had a little bit of a rally lately, but I think over the next couple of years, if I'm right with my stagflation thesis, that with higher inflation and taxes across the board, that higher oil price adds into that's going to hurt restaurants and retail. That's going to take away a lot of consumer discretionary. I talked about this on the last live stream. The other thing is, and this also adds into my higher inflation and higher tax argument going forward, is the pension funds are so underfunded. There was an article on Zero Hedge recently saying that if you live in Chicago, you basically have a $125,000 liability to their pension funds. And so even if you benefited from the Trump tax cuts and you have a salary increase, but you're living in one of those states or cities or municipalities with higher property taxes going, it's going to potentially either offset part of that or all of that, or you're not going to benefit at all if your property taxes are high enough. So a lot of people, if you're on Main Street, if you're a regular person on Main Street or you're a small business owner on Main Street, you have to take into account all these things with higher costs through inflation, higher property taxes. This is all part of a puzzle. And so on the financial TV, they talk about stocks going up, right? But they don't talk about how, the dollar is being intentionally devalued over the long term. They don't talk about inflation and all these things, and how if you live in a certain city or state, your property taxes are going to go up despite the Trump tax cuts. They don't talk about the total picture on Bloomberg or CNBC. Actually, in a lot of podcasts and stuff, they don't talk about the total picture either. I think we're one of the only ones. Okay, guys. Well, we have a lot of comments here on the oil market and gold and silver. I'll answer a few more questions, but I think I pretty much covered the major stuff here about longest bull market in history. It's pretty crazy. This won't be fundamentally driven. If I can make that major point, the stocks may go higher, but it's not going to be really on fundamentals. There was, for a while at least, there was only 5 or 6 technology companies that were moving the entire needle higher. I haven't paid that much attention to a lot of the earnings of a lot of the other companies in the S&P 500 or the Dow for that matter. So I can't comment on how their earnings are going, but I can speak that in general, I know that the CFOs at a lot of these large publicly traded companies, they're not, let's just say, very honest or very transparent with their financials anymore. The midterm elections, things are setting up for, it's total reality TV now on all the news networks, though. It's total reality TV. shit is crazy. Shit is totally crazy on there with all the comments and stuff and all the current events. The midterms are going to be crazy. The best case scenario probably for the midterms is gridlock. It's looking like, well, if the Republicans maintain some type of majority in the House, then it won't be the Democrats are still resisting. They're not really, most of them are not really helping Trump on anything. But if the Democrats take back control of the House, there will be an attempt at bringing impeachment charges. I don't expect them to get past the Senate, but maybe some Republicans will, if the mainstream media keeps repeating the narrative enough, and Michael Cohen, maybe he lies or something like that, that maybe some Republicans in the Senate or House will flip. Maybe some of them will flip. Be convinced by the mainstream media's argument on some of the stuff. I don't know. We live in very interesting times, scary times. They definitely want to, the people in power, the globalists and all these guys, they definitely want to limit Trump's to one term. Kirsten, the market is a voting machine. I would say, well, in a free market, it would be a voting machine. So are you talking about like Benjamin Graham, the intelligent investor? So in the short term, it's a beauty contest or voting machine. In the long term, it's a weighing machine. By weighing machine, Benjamin Graham meant that it's supposed to discount the cash flows accurately. I can make an argument that doesn't really work accurately anymore. There's a lot of companies, Kirsten, that I think are totally misvalued. Where you have companies like grossly overvalued, like Tesla. Tesla has never made a profit, and look at its valuation. It's totally freaking ridiculous. And then you have companies like Sandstorm Gold, which does not financial advice forward looking, has all these investments that are already paid for in their growth pipeline, and the market is valuing all their growth, including revenues that will increase in January. Sandstorm's going to have about a 20% increase in their revenues. The market is basically valuing those near zero. Sandstorm's only being valued on its current producing royalties and streams that are generating cash flow now. All of its future growth that's already paid for in the pipeline is basically being valued near zero. And there's a lot of companies like this. The market is very short-term oriented now. Very, very short-term oriented. So I don't think the market is working correctly. I think the markets, I would blame not only central bank intervention and financial engineering by the large companies and artificially cheap debt, I'd blame these stupid high-frequency trading computers. I think these things are so dumb. I think they intentionally manipulate markets for day trading and create volatility in a lot of different stocks and markets where there should not be that much volatility. These high-frequency trading computers, the exchanges, the New York Stock Exchange and those guys, they benefit from these high-frequency trading computers. They make extra money. So this is another scam, basically. And then it gets people like me fired. So these high-frequency trading computers and these algorithms, they're firing human beings in the financial system left and right. They're replacing smart, experienced money managers and people who do research. They're getting fired. They can't find another job. And so they're getting replaced with a computer trading program that can scan, Twitter or scan headlines. And it is managing all this money and moving in and out of markets and creating all this extra volatility. And it's setting up for very, very dangerous problems in the future with flash crashes and other stuff. I think Deutsche Bank fired, 10,000. Everyone knows Deutsche Bank's a problem, but 10,000 human beings there lost their jobs, and I'm sure not all of them are corrupt banksters. I'm sure there's a lot of good people there. And I think a lot of those people in the financial industry, they're probably, if they're lucky, they're gonna be able to find a job making half the money they did. Probably not even that. A lot of them will be out of work for a while. The financial industry is automating, and I think that's a bad thing. I think it's extremely dangerous. There's a lot of nerds that are doing all these computer programs and managing these things instead of human beings that are more cautious, that have experience through bull markets and bear markets, that do good research. And these machines cannot count. The computer programmers that have made money with these trading machines are claiming that these machines can count for all these variables and are better than human beings, and I would argue that we're going to see evidence that prove that that's not true. These trading systems were somewhat in place in 2007 and 8, but they're nowhere near as prevalent and sophisticated. And so now here we are, almost a decade later since the 2008 financial crisis, and these trading systems, when we do have the next global financial crisis, are going to make things even worse. Adam, Tesla fair value at $80 a share. Yeah, I don't know what its fair value is. Elon Musk has built a brand, and I think he should have stayed with the higher margin, the Roadster and the Model S and a luxury SUV. There is a multi-billion-dollar niche market for that. For the rich Silicon Valley hypocrite a-holes that have a Porsche or Ferrari in one of their garage areas and they can afford a $100,000 more Tesla than the other, there is a market for that. But, Elon Musk trying to be like Henry Ford and trying to save the world and he tried to create a $35,000 electric vehicle, and he obviously failed on that. I don't think he can't make any money off of it. And from what I'm hearing, the features, it's going to be way over $35,000. So I don't know what the fair value of Tesla is, but I would say that, the company is a mess. I think his board of directors is probably going to get rid of him soon. I think they're trying to take away Twitter, and he doesn't want to take it away. I think the board of directors is fed up with that stuff. I would not, Clifford, I would not bet on a buyout for Tesla. I would not bet on that. I think there's going to be a lot of volatility in Tesla stock. This is not financial advice. This is forward-looking and only my opinion, but I think Tesla's potentially ripe for options trading with puts and calls, with long straddles. I think there's going to be a lot of volatility in the stock ups and downs. We know that Elon already basically, he's probably going to get a fine or a warning from the SEC, but we know he intentionally pumped the stock to stop the shorts. So I don't know if he'll try it again to get away with it. Alex Grant, you're a Silicon Valley a-hole, you a-hole. I apologize, Alex. I'm talking about the people at the top. I'm talking about like the Mark Zuckerbergs and the people at Google and YouTube who made sure that I can't make a living off my content. My channel is actually 3 times larger than it was in 2015, and my Google AdWords revenues on my videos are actually down more than 90% from 2015. I apologize, Alex, if I included you there. I'm talking about the people at the top. I'm sure if you're listening to this podcast, you're probably more like James Damore, which big tech, the social media people are trying to run all those guys out. They have to be silent. You speak up at work there, you get fired. You get blacklisted. Just like me in the financial industry, if you speak out and criticize the Fed, you get in trouble. Cadusa, if when the Fed Reserve stops printing money, pension funds are toast that day. Yeah, I would agree. Pension funds are already in trouble. You're seeing this in California, where the pension funds are going to Sacramento, which is the state capital of California for our foreign listeners, and they're demanding that the state capital, the politicians in Sacramento, raise taxes on pretty much everything across the board in California to start meeting up for those underfunded pensions. So I would think that a lot of politicians in other states and cities where there's the largest pension fund shortfall, and it's most likely to occur in the near term, that's going to happen as well. The other thing is people have been speculating that potentially California could go to the federal government for a bailout, but I think it's more likely that they will try to layer taxes across the board. Normally what these areas do is they go after the tourists first. So my buddy went to California a couple years ago, and he said he was paying like a 10% tax on rental car and airport and hotel, and just ridiculous. So if you rented a hotel there in California as a tourist, there's a 10% tax. There's a huge rental car tax. All these things. And so they're going to layer these taxes on. They can't rob you all at once, so they got to layer these things on. So most people don't even notice them that much. Or if they do notice them, then they can blame capitalism. Michael Quick, if what collapses, what happens to public works pensions? The stock market collapse or something else? Michael Quick, the government is the market at least 70%. Well, right now, the U.S. economy, a lot of the U.S. economy is based on consumer spending and government spending. So the GDP is a very flawed statistic. Murray Rothbard commented that, government spending should be subtracted from GDP. and I would agree with that. So yeah, I don't know if you have the number exactly right, Michael, but yeah, the majority of the U.S. economy is based on consumer spending, and the consumer, if oil prices rise or the property taxes or other taxes go up, they're just not going to have the discretionary spending, even with the Trump tax cuts. So inflation and taxes long term are going to be the new normal going forward. But I'm not sure if it's 70% for government spending, consumer spending total, but it's a very large chunk of the economy is government spending and consumer spending. Okay, guys, well, we're almost at an hour, so maybe I wasn't planning on doing a really long live stream today, but if you have more questions, put them in the comment section of the video after this video is done recording, and we'll discuss more from there. Okay, I'll answer one more question. Omar, Jason, do you think the stock market crash next year? Because most analysts thinking. I don't want to do the exact timing, just obviously not financial advice, just my opinion. I'm tired of this game where everyone tries to guess it. We'll just have to see. I think there's going to be volatility. So if before the stock market does crash, we're going to have violent corrections first, and then we're going to have maybe a bear market rally. So we probably will have some type of topping process. We almost had a topping process earlier this year. So the crash in February before the rally, a lot of technicians were saying that the stocks had topped then. So if you go back and look from February, when we had that problem in the VIX and it blew up some of the VIX ETFs, or almost blew up some of the VIX ETFs. And so a lot of smart stock market technicians, technical analysts that I follow, were saying the stock market was topping then. But a topping process doesn't mean a crash right away. It could be, drop 10%, rally. Drop another 5 or 10% or 15% and then a rally. So it's when there's a lot of chop, back and forth, short rallies, small corrections or crashes, those things, and you see evidence of this happening over a month's period, that would be then probably the chop. If there's a lot more volatility, the average person may pull out more money than from stocks. You guys are having fun in the comment section there. You're talking. There's so many comments here. There's no way I can answer them all right now. Okay, so I will try to answer more of your comments from this chat after the video is done. We're gonna wrap it up right now, and very interesting right now that we've had the longest stock bull market in history. We're setting up, I think, over the next couple years for a lot of fireworks, a lot of volatility. We haven't had the volatility except for February, and so I expect probably volatility towards the end of the year and 2019. It should be very, very interesting times going forward.